Okay, we are delighted to welcome George Anson from HarbourVest, and we want to briefly talk about listed versus non-listed private equity. So George, so what are the incentives for private equity investors to choose listed or non-listed private equity?
Nicole, I think, with every investment opportunity there are advantages and disadvantages, but I think in the listed private equity space there are probably more advantages than disadvantages, and I can think of 6 main advantages. The first has to be with the liquidity that's available for investors. Obviously the listed stock is publicly listed on the stock exchange, whereas investing in a private fund it's not. And that affords investors the ability to be able to trade in the stock one day and trade out the next, which I think...
Couldn't he use the secondaries market for that?
Well, this is true, but for private limited partnership interests, they tend to trade at a discount, and that can take some time as well to affect a transaction. Here you can literally trade in one day and trade out the next day, assuming you're not a massive investor. I think the other interesting thing about the listed space is that there's generally available research, which you wouldn't ordinarily find on private equity managers in the unlisted space.
I see. And so, what are the key advantages from your point of view?
Sure. I think the other interesting thing from an economic model point of view is that most private equity programs that are listed on the stock exchange trade at a discount to net asset value. And if you think about that as a value proposition, let's say it's trading at a 25% discount, you can buy $1's worth of assets for 75 cents, which has to sound pretty compelling if you believe in the quality of the underlying manager and the long-term expectation of outperformance. The one issue with that, of course, is that to realize that NAV, typically the fund or the program would have to go into a runoff mode or be taken over. One of the other aspects about listed private equity is the governance of it. You have a corporate structure which tends to be evergreen and would typically pay dividends, but it also has the corporate veil, and it also has a board of directors which tend to be non-executive and independent, thereby representing the interests of the shareholders. Investing into a private fund, you do have an advisory committee, but they have no powers of governance. They can advise the manager, but ultimately it's the manager themselves who decides how the fund is run and how it's managed. The other aspect of a listed vehicle is transparency. And what I mean by that is that for the investor buying a share or investing in the publicly listed vehicle, they pay the same fees, they suffer the same total expense ratio of a large investor. And that may not always be the case in a privately listed vehicle, or private vehicle, where large investors may be able to command a discount on the management fee, and thereby the smaller investor is paying a higher fee than the large investor. That doesn't happen in the public domain. But last, and by no means least, I think the reason why investors invest in listed private equity vehicles is for the returns. If you look at the historic track record of many of the investment vehicles that are available today, they have met the objective of outperforming the public markets over the long term. And I think that investment thesis is still valid in today's marketplace.
Thank you very much, George, for coming today and for participating in our symposium, and excellent to have you here today. Thank you very much.
It's been my pleasure. Thank you.